Proud supporters of Africa this week. Engen, with us, you are number one.
Transnet Rail Engineering, a unit of South African parastatal Transnet, this week toasted the acquisition of 143 diesel-electric locomotives as part of its 110 billion rand capex program. This program is intended to strengthen the country's rail, port and pipeline systems. Uche Okoronkwo was there.
In a bid to improve the reliability and efficiency of its stated railway systems, Transnet is investing in the first diesel-electric locomotive fleet to be introduced in sub-Saharan Africa.
The plan was outlined in the context of an aging fleet that we have, and is based on our predictions of the demand that is out there in the market for the transportation of freight. And the Class 43 locomotives are an integral part of the fleet plan, which will enhance our ability to run a scheduled railway and deliver a reliable freight service to the South African economy.
The fleet was purchased from U.S. conglomerate General Electric.
It's the first time we've been able to really bring this technology to Africa. And it's a tremendous efficiency savings for the railroads. You probably heard earlier, 2 can do the work of 5, or 3 can do the work of 4. It saves, there's up to 600,000 liters of fuel that can be saved. A number of productivity enhancements for the railroad.
This acquisition will have a significant impact on South Africa's rail efficiency and industrial capacity, expanding the country's regional market share in the manufacturing of rail equipment and increasing its targets for commodities transported by 200 million this year. Minister of Public Enterprises, Malusi Gigaba, emphasized the importance of this project to South Africa's growth plan, specifically in generating 5 million new jobs by 2020, migrating its industrial transport systems from road to rail, and repositioning the country as a leading manufacturer of rail equipment in sub-Saharan Africa.
We're going to establish South Africa as a manufacturing hub for locomotives and wagons. So, as therefore an original equipment manufacturing hub, which would be able to supply not only to the freight and passenger rail system, but also which will be able to supply to the African market and even other markets overseas.
He also affirmed his plans to adopt new financing models, which include public and private partnerships, as it increases its investment in logistics.
We are in a process of looking at the financing mechanisms through the Presidential Infrastructure Coordinating Commission. But the Department of Public Enterprises itself has also been studying the financial models that we can use to support our infrastructure expansion program. To that extent, we are confident that in due course, Transnet is going to announce an expanded capital investment program.
As analysts predict that South Africa's growth will slow further than the Reserve Bank's 3% forecast this year on the back of another recession in Europe, projects like this will play a major part in keeping South Africa on the right track to surviving these turbulent times. Uchechi Okoronkwo, CNBC Africa, Pretoria.
The value of commercial property in Kenya appreciated by 15% last year, driven by higher preference by business owners to buy property than rent out. The gains place commercial property as a leading asset class for investors. Leila Macharia, Managing Director of Sion Real, gave insight into the sector.
The real estate market is still quite robust. With the stock market not doing very well, we are seeing much more interest in the property markets. We have some of the large firms actually shifting their interest more to the property markets to kind of make up for some of the hit that they're seeing in other sectors. It's important to point out, though, that the overall investment outlook still seems quite positive across sectors.
You know, what we are seeing, obviously, with everybody concerned about interest rates, is the borrowing costs that have risen in general. You know, to get a mortgage in Kenya, to do business in Kenya, it's become quite expensive. How does that translate into the property sector? Because certainly a lot of developers need to get loans from banks, and if you're going into residential, you need to get a mortgage from the bank. So in that context, how attractive will property continue to be?
You're absolutely right. We have seen our interest rates double over the last few months. Part of the central bank's efforts to slow down a very high rate of inflation that we witnessed last year, and also to try and tame the escalating currency depreciation that we saw in Kenya, also in other parts of Africa, but in Kenya. And it has had a bit of that effect. We've seen the currency rate stabilize somewhat. But the flip side of that is that we have seen reduced borrowing across the sector because of the high interest rates. We do expect the property market to be affected by this, of course. Although the long-term outlook remains strong, we do think that this year we'll see a bit of a hit with a bit of a cooling in the price escalation that we've seen in previous years.
Now, Leila, despite the returns of 16% in real estate, we're told it's still a difficult business to get into as a property developer, largely because a very small component of bank lending goes into the sector. If you're a property developer, you've got to be able to find your money elsewhere, not look to the mainstream sources like banks. So where do they find the money? How do they set up shop?
It's a great question. And we have come to realize that a very large portion of our economy as well as our financing is informal. So the mortgages, for example, are, they say that we have about, 13,000, maybe 15,000 mortgages now in total in Kenya. And we know that we've had robust growth. So what that tells us is that most people are finding alternative ways of financing. Now, for informal developers, people who are doing small multi-unit buildings, then the very mainstream lending might not be a factor. But for large developers who are formal, definitely most of them get their financing for property from the banks. So we are expecting that this will have an effect. But overall, for the growth of the sector, we do expect that to remain still buoyant, although affected by this somewhat.
All right, let's talk about those big developers and companies in general. We've seen a huge impetus, for instance, of if I think of Sasini, a tea manufacturer, moving into real estate, selling off some of its coffee plantations for real estate developments. This increasingly seems to be the trend. Why are companies moving in this direction? Obviously, it's the buoyant market, it's the returns, but why would a company move from its core business, agriculture, into property?
Okay, so there's a number of factors that are affecting this. The first one, of course, is that the long-term fundamentals of our economy point to a very sustained boom in real estate over the next few decades. We've talked about this before, the strong urbanization rate, household formation, strong economic growth, and a very fast-growing middle class. So anybody who's an investor right now looking at Kenya or even East Africa needs to be looking at real estate. A lot of these large firms that had, coffee farms and sisal farms and the rest have very large holdings of real estate, of land, which in the beginning might have been idle, but over the last 10 to 15 years have become very, very valuable. And from an economic rationality point of view, you see that many of them will start looking at real estate as the best way to optimize their returns now.